2024 can be the year you or a young person in your life start investing if you make resolutions for the new year. But where should one begin? Purchasing stock in a few well-known companies whose stock price you're certain will climb might be your initial instinct. Ultimately, there are countless tales on the internet about how successful one may have been if they had invested in the appropriate stock at the appropriate moment. However, Christine Benz, Director of Personal Finance and Retirement Planning at Morningstar, believes you would probably be making a mistake. According to Benz, young individuals should concentrate on constructing a diverse portfolio, utilizing inexpensive mutual funds and exchange-traded funds, rather than beginning their investing journey with a small number of individual equities. Are you ready to master your money? Like this video and subscribe to our channel for more weekly insights. There's a good reason why financial experts like Benz advise clients to create widely diversified portfolios. Even if the stock market's historical trajectory has generally been upward, any one stock has the potential to see a severe price decrease and completely obliterate the gains on your portfolio. If you invest in a small number of well-known stocks, you run a significant risk of losing money if one or more of your choices underperform, which is a common occurrence for beginners in the stock market, according to Benz. Also according to Benz, people are choosing individual stocks to invest in based on companies they are familiar with. Often, they lack the knowledge to conduct thorough research on organizations. They will therefore frequently choose stocks without having the knowledge necessary to make wise choices. If you feel ready, take notes on the topic to make the most progress. Picking stocks is hard, and you can't do it consistently. This is the straightforward reality of picking stocks. Some of the greatest investors and economists of our time have agreed with it. If someone tells you otherwise, then they're probably trying to sell you a scheme or a course. However, a lot of investors are enticed to give the stock selection a shot, so it makes sense to examine the reasons why it might not be a wise decision. Let's go back a decade. It's 2011. The world's financial crisis is at last ended. You conclude that now's a suitable moment to begin investing. In the United States, there are 100 of publicly traded companies, and the number of companies that go public each year continue to rise. It's difficult to pick which firms to invest in, so you settle on several well-known dependable brands that you're familiar with: General Electric, Sears, Kodak, and Ford, also referred to as blue chips. For fun, you can also take a chance on Groupon, a relatively new startup that recently went public, since almost everyone you know uses it to try out new things at a discount, and the sellers benefit from more visibility and new business. Now, let's jump ahead 10 years to 2021. Here's how your stock selections perform. Well, oops. All 5 of the selections were dreadful. Sears is bankrupt, and so are all the other companies with the exception of Ford. With the advantage of hindsight, it is evidence that these companies were bad choices in 2011. For instance, it's possible that you were aware in 2011 that retail will be replaced by internet shopping, and that's why you avoided investing in already troubled Sears. It's not that easy though, as other retailers, including Costco and Home Depot, have had phenomenal success in the last 10 years. One could actually argue that Home Depot is an anomaly, since it offers items like timber that are difficult to purchase online. However, Sears sold timber, as well as appliances, and tractors, automobiles, and tents, and even prefabricated mail-order homes. Throughout its existence, Sears had offered almost anything for sale. The greatest mail-order catalog in the nation used to be Sears Catalog, as older people may recall. Millions of families received it, and you could order almost anything from it. In actuality, it was Amazon.com before there was an internet. Many other traditional retail stores, including Sears, were facing financial difficulties by 2011. However, there was a cautious hope that Eddie Lampert, the board chairman who had saved Kmart from bankruptcy, could save Sears as well. Regretfully, that didn't take place. However, several stories claim that Sears was a once-in-a-lifetime investment opportunity, as late as 2016. After 2 years, Sears declared bankruptcy. We have some indications as to which companies might perform well in the near future, at least over a 10-year time frame. When Apple originally introduced the iPhone in 2007, for instance, it took off like wildfire and eventually ignited a technological revolution that gave rise to a whole new sector. Thus, it was reasonable to assume in 2011 that Apple would have great success in the ensuing 10 years. Based on its market valuation, Apple is currently the biggest company in the world. But in its ensuing 30 years, what will happen? Essentially, everything is lost when we increase the duration. Recently, Warren Buffett, possibly the greatest investor of all time, shared some fascinating slides in his presentation at the annual Berkshire Hathaway shareholder meeting, which took place on May 1st of 2021. Buffett, the most successful active investor in history, has always said that the average investor finds it difficult, if not impossible, to pick stocks, and he is a big supporter of index funds like the S&P 500 Index Fund. He displayed a list of the top 20 global corporations by market capitalization as of March 31st of 2021 during his introductory comments. There were some particularly noteworthy points by Warren Buffett. Since the Saudi government owns 98.5% of Saudi's Aramco shares, the firm is state-owned and not, in the conventional sense, publicly traded, even though it is technically possible to purchase shares. 13 of the top 20 corporations are American, as are 5 of the top 6. The list comprises of publicly traded American corporations that are all part of the S&P 500. Buffett continued to commend American companies, stating that he has always been a fervent patriot. Buffett then asked an intriguing question. In 30 years, how many of these 20 companies will still be listed? You might predict 8, 5, or any other positive number. Without a doubt, these businesses are the best in their respective fields and are not going anywhere anytime soon. But of course, no one knows the future. Do significant drops in your portfolio always mean a bad thing though? Benz claimed that a lot of people view them as an important lesson. While you get a first-hand understanding of investment, there are others who fervently think that the greatest approach to begin investing, according to her, you feel like a business stakeholder because you have a connection to that company. However, Benz contends that you can learn about well-known businesses without putting yourself or a young person at the danger of suffering a significant loss. Even still, there's no denying that owning a single stock is unquestionably more thrilling than owning an index, particularly if you're attempting to introduce a young person to stocks. I don't think that's a big deal if you want to make a token investment in a company that your kid likes or understands, advises someone trying to teach a lesson, and the general guidelines are the same if you're investing for yourself. According to Benz, it makes sense to allocate about 90% of your assets to a portfolio that is well diversified. Choosing stocks is obviously a difficult task for investors. An investor may receive enormous gains from some stocks and not so with others. It is impossible to predict which stocks will perform well and poorly in advance. And it's not a good idea to put all your eggs in one basket unless you want to gamble with your life savings. But as we've already shown, the alternative is not to invest. Additionally, we have observed that the value of the stock market as a whole, as determined by suitable market indexes such as the S&P 500, continues to increase over time. Thus, a lot of individuals think that investing widely in many different companies across all industries and sectors, and even across borders, is the greatest approach to making long-term financial decisions. Diversification is the term for this concept. It not only lowers the possibility that any specific stock selection will perform poorly, but it also locks in profits for future improbable winners. Purchasing shares of dozens, hundreds, or even thousands of firms by hand is a surefire way to diversify. This can get very tiresome, and this also becomes highly costly in the days where the majority of brokers charge commissions on stock trading. Additionally, this strategy can be very capital intensive because you have to buy a minimum of one share of each stocks, and some stocks are very expensive. And last, it would be a headache to manage a portfolio like this. Thankfully, investors may accomplish this without any difficulty at all by using mutual funds and index funds. It follows that the most widely used financial products in the world today are index funds and mutual funds. We hope you learned something new from this episode. Like and subscribe for more useful financial content, and see you in the next one.